Stocks trading at record highs as rate cut optimism is still growing. But Bob Diamond, CEO of Atlas Merchants Capital, warning the following. The Fed is likely to proceed with caution. A rate cut or even two this year could occur, but the economy is likely to continue to demonstrate that it can handle the current level of interest rates. Bob Diamond, I'm pleased to say, joins us now and joins us for the hour. Bob, good morning to you.
Morning, Jonathan.
Let's get into the data, and it's fantastic to see you, sir. Retail sales were solid, jobless claims were low, optimism is picking up. What evidence is that we are, quote, sufficiently restrictive at the Fed?
So, you know, I think consensus, Jonathan, in my mind is about 1% growth this year. The Fed is a little higher, kind of 1.5% growth. I think it might be a little bit higher than that. And as I look at the year, if the Fed were to be aggressive in rate cuts, first quarter or second quarter, I think they run the risk of the economy accelerating a bit and therefore inflation accelerating a bit. And that's just a position that the Fed is not going to put themselves in. So my sense is that the right way to look at this, rather than the markets, or if you look at the Fed fund futures, they look at 150 basis points this year, and it's kind of front-ended. My sense is maybe one or two 25 basis point cuts, second half, maybe closer to the end of the year. And I just believe the Fed, for very good reason, is going to remain cautious. They pretty much played a blinder since they recognized that inflation was spiraling, frankly, out of control not that long ago. We're in a very good position now, and I think for the Fed to act too quickly would put them in a difficult position. So our sense is the markets are well ahead of themselves in terms of rate cuts, you know, maybe second half.
When you say markets, bond markets or stock markets? Because what I find interesting is how many people are saying this is a bond market problem. It's not a stock market problem, because if the economy is better than good, that's going to be positive for risk assets.
Yeah, and I think, Lisa, it raises another issue, which is we were for so long at zero interest rates or 1% interest rates. I mean, we all remember here, world before 2008. From 2008 until very recently, Fed funds averaged about 1%. Before that, for decades and decades and decades, Fed funds averaged around 4% or a little above 4%. So where we are today is not abnormal. And our sense is that the economy is adjusted reasonably well. We see that in, you know, kind of the calmness in the bond markets, the calmness in the equity markets. So there's not a panic here by the Fed to lower interest rates.
You were at Barclays leading the charge there for quite a while, Credit Suisse, First Boston. You've been in the banking business for a long time. There's a lot of angst about what the future of the banking industry is going to hold at a time where, yes, interest rates are higher, but also there's a whole host of regulation that's crimping the lending activities of a lot of these banks. You've referred to them as utilities. So where is the opportunity at a time where it seems like lending could be profitable if there weren't so many constraints?
So I think we're seeing, point one would be, if you look at the U.S. banks, and if you look at what we typically report as earnings, we tend to report the big banks. And the big four, the big six in the U.S. continue to get larger, more concentrated than they were prior to 2008. And I think that concentration does weigh on me a bit. Do we really think that fewer banks, larger banks, more concentrated banks is better for the U.S. economy? I really don't think so. I think one of the things that's been the lifeblood of our economy, and the reason that the U.S. reacts so quickly to negative news and negative periods, particularly relative to Europe and other sectors around the world, is because of the diversification of the financial services industry. So I do worry about that. And I think earnings have been good, but the larger interconnected banks are becoming much more like utilities. And so the push back on higher capital levels, I actually think is going to be ineffective for just that reason, because the banks are becoming more concentrated and they are becoming larger.
So what do you think of this impact of these new capital requirements? If you like the U.S. regional banks, they potentially face even a tougher road ahead.
Well, I think a lot of that capital is for the larger interconnected banks, what people used to refer to as too big to fail. And I think that's where the biggest impact will be. And I can kind of understand both sides of that argument, Anne-Marie. On the one hand, you know, the banks are saying higher capital levels, while we're safe right now, which they are, is going to lower ROE and reduce lending, which is true. On the other hand, if you're a regulator and you're worried about ever being in a position where there's systemic risk or too big to fail, even though the banks are doing great and they are safe today, the risk, if there was a failure of systemic risk, is greater. In my view, and this does fit my book, we really love to invest in the regional banks, and we're looking at it. So I want to claim that that's kind of our bias. But there's 4,000 or so regional specialist banks today. There's no country that has that kind of a financial services industry and that kind of a reach. The benefit that those banks have for small family-owned businesses, which again, the lifeblood of the U.S. economy, is really important. There will be consolidation, and I do think that those banks are reacting well to higher interest rates now versus, the immediate impact of higher interest rates. So we think there's going to be terrific opportunities in regional banks. We love that as a space to invest in, but most importantly, we think it's incredibly important that we provide opportunities for those institutions to continue to grow and serve small and medium enterprise businesses.
Based on that, it sounds like you think we're through the storm of last spring.
In terms of regional banks,
yeah,
for sure. I think there were a couple of things, Jonathan. I think every bank, large, small, medium, had to adjust their portfolio to higher rates. When rates go from 1% to 5%, it's going to impact. You can't have a positive impact of that. You have to weather it. And I think that's been managed pretty well. I think the second thing is there's been a lot of worry about the loan portfolios, particularly commercial real estate. And I think we're beginning to recognize that for many of these regional and more specialist banks, their focus on commercial real estate is more in small cities around the country as opposed to New York or LA. So I think the markets are getting more comfortable that the crisis is behind us. But I do think that there's an opportunity for consolidation. The impact of regulatory capital, the impact of regulatory intrusion post-SVB is increasing costs. I think the higher interest rates for a while increase costs. So some of the very, very small regional and specialist banks, although very, very sound, are going to really struggle to get the ROE to appropriate levels. So we'll see some consolidation there.
Just quickly, language matters, investing versus buying. Would you be interested in taking over a regional bank in the United States of America?
As an investor, would I love that as opposed to an operator? We do think of ourselves not just as investors, but as operators. And so if we make a significant investment in an institution, a regional bank or Panmure Gordon, as you and I have talked about in the UK, staying as non-executive, staying as investors, we can still have a pretty positive impact on the growth. So that's how I look at it. Would I love to get really, really involved with a couple of regional banks? Absolutely.
Absolutely.
Yeah.
Where would they be? Have you identified one?
I can't say that.
I'm trying to get to it, Bob. We're trying to tease this out in this program.
Very good question, though.
Bob Diamond.